and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we have been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you are listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Andrew Cartwright, investment manager based out of our Birmingham office. And this week, I'm delighted to be joined by regular commentator and head of fixed interest research, Richard Carter, and by fund analyst, Carly Moorhouse, who covers the Asian and emerging market regions. Welcome, Richard and Carly. So in last week's podcast with Anthony Webb, we were still coming to terms with what had happened in Iran and the immediate market reaction. Since then, we've heard Donald Trump suggest that the Iran conflict was almost over, and we did see a brief rebound in equity markets last Tuesday. However, as we've all learned, President Trump's comments do need to be taken with a large pinch of salt, and in reality, the conflict has intensified ever since. There have been continued missile attacks across the Gulf region and further Israeli strikes on Tehran. Now, the escalation has kept oil prices elevated, and this morning it is back above $100 a barrel. And global equities have continued to swing sharply as investors attempt to interpret the shifting geopolitical landscape whilst reassessing the inflation risks. So, Richard, just coming to you first. So, despite President Trump's comments, we have seen a clear escalation in the Iran conflict. The situation remains extremely fluid, and as yet it's very unclear how long this may continue. But could you give us an update on how events have progressed since last Tuesday and your thoughts on how financial markets have responded? We've obviously seen a lot of volatility within equity markets and oil price, but have there been any signs of stabilization, and have bond markets and gold behaved as the traditional safe havens that we might expect in circumstances like these?
Yeah, I mean, there's absolutely, you're absolutely right. There's no sign of this conflict easing off at all. Both sides, really showing no interest in backing down, and despite, I guess, Trump's hopes that this would all be over quickly and it'd be maybe a revolution in Iran or whatever, that shows no sign of the regime being toppled from power. So it is a big concern, and obviously, as far as the global economy is concerned, getting ships and supplies and whatnot through the Straits of Hormuz is proving very, very difficult, which is why we're seeing this big increase in energy prices. I mean, I do think the market, just people in general, still think this is a hopefully short-term kind of temporary shock. I think actually, although we have seen choppy markets, the sell-off, I think, and sort of look at things like the VIX, sort of measures of volatility, they're not extreme. And as I say, I think that's just down to people thinking this can't go on for too long. Maybe soon Trump will just sort of declare victory and sort of walk away, even if that is kind of a temporary solution. It means no changes in Iran. So that's still the hope. But, finding an off-ramp is going to be difficult. And all this sort of talk of, escorting ships through the Straits of Hormuz while there's sort of missiles flying everywhere does seem to me a little bit fanciful, and not surprisingly, supposed allies of the Americans who Trump has just spent the last sort of 6 months criticizing don't seem to be sort of rushing to help, which you can kind of understand. I mean, in terms of markets, as I say, oil prices really been the main pain kind of point for everybody because of what that means for inflation and sort of weaker growth. That's feeding into higher bond yields. So, we were hoping for rate cuts this year, but as long as this is going on, it's really very unlikely. So bonds not proving much of a safe haven at the moment, unfortunately. And gold, interestingly, has been on a fantastic run. You would think probably it would have rallied on the back of all this as well, but it hasn't. It's actually fallen slightly, and I think that's down to just sort of maybe expectations of higher interest rates or just the fact that the dollar's been quite strong. So I'm afraid safe havens is going to be few and far between, but I think the reaction in markets has been, certainly in equities, relatively sanguine so far.
Richard, well, let's hope that the conflict does come to an end shortly. But in the meantime, we've also got some other events going on this week. We've got the major central banks, including the European Central Bank, the US Federal Reserve, and the Bank of England, all meeting this week to set interest rates. Now, the interest rate easing cycle had been widely expected to continue in both UK and the US during the year. However, last week's UK data, which covers the period to the end of January and doesn't yet reflect the impact from the Iran conflict, it paints a fairly mixed picture. We saw UK GDP for January come in at 0%, which was below expectation as uncertainty weighs activity. And inflation fell to 3%, and unemployment rose to a new 5-year high, with a slowdown in hiring most noticeable within the consumer sectors. Now, ordinarily, weak GDP and rising unemployment would strengthen the case for rate cuts. However, inflation, while it is lower, remains above the Bank of England's 2.5% target, and renewed pressure from higher oil prices complicates the outlook. Richard, this combination must place the Bank of England in a difficult position, and indeed, you mentioned in last week's podcast that interest rate forecasts have been swinging wildly between rate cuts and hikes. How do you think the Bank of England will interpret this mix of weakening growth but rising geopolitical inflation risk? Do you believe that events in the Middle East will have a meaningful shift in expectations for this week's meetings? And finally, just look at the US. What are your expectations for the Federal Reserve? What do you think policymakers there will be watching out for most closely?
Yeah, I mean, you're absolutely right. I mean, the UK economy, from a number of measures, and obviously you mentioned rising unemployment and the growth as well. It kind of probably needs lower interest rates, and yes, inflation's still above target, but the trend has been down. So, ordinarily this week, Thursday meeting, we might have expected a cut, and certainly, not so long ago, markets were expecting 2 more this year, which would have made a lot of sense. That has swung wildly, as you say, and we're now sort of back to pricing in kind of almost no change, maybe, or certainly no change this week, and maybe higher rates later in the year. It's entirely dependent on what happens in the Middle East. I think if the conflict was resolved, this week, then it'll be seen as a temporary shock, and then very quickly rate cuts come back onto the agenda. But it's impossible for the central bank, for the Bank of England to be cutting rates now and trying to deal with this, because they know if inflation gets out of hand, they'll be absolutely crazy to cut rates going into a sort of inflation shock. So they'll sit on their hands. They'll hope the conflict, a bit like the rest of us, hope the conflict is over, and then they can resume rate cutting in the next few months. And I think it's a similar story for the Fed. I mean, the US economy is stronger probably than the UK. Inflation is potentially a bit more sticky, but obviously you've got the sort of pressure from Trump and all the rest of it to get rates down. And labour markets are okay in the States, but they're not exactly they're not exactly a sort of full employment or causing big inflation issues. So the Fed ordinarily would be getting close to another rate cut, but that just can't happen now. And I think they'll be watching. Like you asked about what they'll be watching. How long this conflict goes on, what domestic inflation impact there is. Does higher energy prices feed into sort of second round effects like wages and all the rest of it? And then set against that, what's going on in labour markets. But I think for now, they've got to be on hold, and then we'll see where we are in a month's time. Hopefully they can resume cutting rates.
Thank you, Richard. Now, the conflict in Iran and its impact on oil prices and ultimately inflation has global repercussions. And based on last week's market performance, the worst affected equity markets were overwhelmingly in Asia. So to have a closer look at what's been going on there, I'm delighted to welcome back Carly Moorhouse. And as Carly and I have discussed in a previous podcast, we can't just look at Asia as one homogenous region. The underlying economies are incredibly diverse. And interestingly, the performance of the equity markets of the 2 largest economies, India and China, are often negatively correlated. Carly, we were chatting last week about Asia, and you highlighted that it's South Korea that's been one of the most adversely affected equity markets. And of course, we can't talk about Asia without including China and India. Could you give us an overview and your thoughts on what's been happening within the Asian markets over the past week? Are we simply seeing the most oil-dependent economies bearing the brunt, or are there additional factors at play?
Yeah, so starting with South Korea, the Kospi, which is Korea's main equity index, has seen some pretty big moves since the war in Iran began earlier this month. Part of that is the view that as a country that imports about 90% of their oil, with about 70% coming from the Middle East, they're going to be hit pretty hard by a prolonged spike in energy prices. So we saw almost all companies down quite a lot at the open after the US launched their first attack on Iran. With most companies down double digits, which I think in itself is quite telling, as even defense companies were down in the immediate aftermath, which logically you would think should perform well in this environment. And that's why it does seem like more profit taking and risk reduction, as opposed to a concern that these companies and their fundamentals are going to be significantly impacted. The KOSPI was up close to 50% year to date before the war began, and now it's still up about 30%, which shows how big the moves this year have already been in Korea. And that's not even taking into account the strong stock market performance in 2025, with the Korean index up over 80%. And a lot of that was led by the memory names, SK Hynix and Samsung Electronics, which together make up about a third of the index. So their influence is large, and with each still up over 100% in the last 12 months, I don't think it's surprising that these have been the hardest hit. But of course, it remains to be seen whether these two companies that are very global in nature and in high demand will suffer disproportionately relative to other tech hardware names simply from being based in Korea, should the war continue for a prolonged period. Turning to India, the Indian market has fallen about 8% this month. However, it was already quite the laggard in EM year to date, as it has been for over a year now. India is also a big oil importer, so that's played on investors' minds. They do have some reserves, but not a huge amount. However, they have been expanding their supplier base heavily, and only 40% of their crude comes from the Middle East. They're obviously still buying from Russia and recently said basically that they're going to do what's best for the country. And the US last week eased sanctions on Russian oil to help oil flow. So this type of thing could help India, but as a very domestically focused, consumption-heavy economy and index, higher inflation from oil could certainly have an impact. And then China, again, sits somewhat apart. So energy security has long been a strategic priority for them. And this is just reinforcing the push towards renewables, grid investment, and electrification. And they're already world leaders in these technologies. China also has diversified crude sourcing and built inventories over time, with the estimated amount at about 3 months worth. But also macro-wise, China's starting point is a little bit different. So while most emerging markets and even developed market economies are concerned about higher inflation, China's been dealing with disinflationary pressures. So slightly higher imported inflation. It's obviously not costless, but it's not necessarily negative for them. And perhaps that's why the CSI 300, which is the onshore China market, is about flat month to date. So, seeming to be relatively resilient. The Hang Seng, which is offshore China, is much more foreign investor dominated, and that's down about 4%. And that divergence could be explained by the more negative view of foreign investors on the impact that this is going to have on China, as opposed to what people on the ground feel. So more broadly, we are seeing the most oil-dependent economies bearing the brunt of the shock, but equally, those are some of the markets that have been performing the best year to date. So certainly an interesting dynamic.
So global geopolitical tensions and conflicts are nothing new, and whether that's China, Taiwan, North and South Korea, or what we're currently seeing in the Middle East, these events can flare up without warning and often resolve just as quickly, perhaps with the obvious exception of Russia and Ukraine. But Carly, from your perspective as a fund analyst, how do you typically decide when a geopolitical development is significant enough to influence your fund recommendations or change your stance on a manager or a market? Is it a specific market reaction, changes in company fundamentals, or something in your ongoing risk framework that prompts you to change tack?
But when we select managers, one of the many things we consider is how the market, how they might react to situations like this. Emerging markets include some very politically and geopolitically sensitive areas. So the risk for these types of things, unfortunately, tends to be more so than in developed markets. What might cause us to change our fund recommendations is knowing the types of companies or sectors a fund is exposed to, whether that portfolio manager is willing to be flexible because some are not, and whether or not it's going to be a good environment for those types of companies going forward. That is, of course, if you think whatever the situation is going to continue on long enough to start to impact the fundamentals of the businesses that they hold. It's obviously impossible to know for certain how they will react going forward. But in our due diligence, we make a point to understand how they've reacted in the past to similar situations. And ultimately, having conviction in a manager overall is having conviction in them to position the portfolio appropriately for these types of things. But we do have very good relationships with all of our managers. We speak to them a lot as is, but in these types of situations, even more so to understand their thinking as things evolve.
Well, thank you very much, Carly, and to Richard, of course, for those great insights, and to you all for listening. So, did you enjoy our discussion on the podcast today? We love to hear from our listeners, so please review the show now wherever you're listening and share it on your socials and tag us at Quilter Cheviot. To make sure you don't miss a future episode, tap the subscribe button. We'll be back next week, and in the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. You can stay up to date with our thoughts on the current conflict and other market news, industry insights, and our upcoming events and webinars on our website or our social media pages. Finally, do you have any questions you'd like to ask one of our experts for our next podcast? Simply ask them via the weekly comments page on our website. We love to hear your questions. And that's it for today. So thank you again to Richard and Carly for your time today, and to you all for listening. See you next time.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.